Understanding short squeezes, a high-stakes game in the stock market. Short squeezes are dramatic events in the stock market. They involve a sharp and sudden increase in a stock's price. This surge happens when short sellers are forced to buy shares to cover their positions. Let's break down how this works. Short selling is a betting strategy. Traders borrow shares of a stock they believe will go down. They then sell these borrowed shares at the current market price. Their goal is to buy back the shares later at a lower price. The difference in price is their profit. However, if the stock price goes up instead of down, short sellers face losses. As the price rises, they may be forced to buy back shares to limit their potential losses. This buying pressure can accelerate the price surge even further. This is the essence of a short squeeze. It's a situation where short sellers get caught in a losing bet. They are squeezed out of their positions as the stock price climbs against their expectations. Wednesday's rally, a tariff-fueled surge, not a short squeeze. On Wednesday, April 9, 2025, the U.S. stock market experienced a remarkable rally. The Dow Jones Industrial Average soared by almost 3,000 points. The S&P 500 surged by 9.5%, marking its best day since 2008. The tech-heavy Nasdaq Composite Index also saw a massive gain of 12.2%. This was its second-best daily performance ever. This surge was primarily driven by President Trump's announcement of a 90-day pause on new tariffs on Chinese goods. This news injected a much-needed dose of optimism into the market. Investors were relieved to see a potential easing of trade tensions between the U.S. and China. This positive sentiment fueled the buying frenzy on Wall Street. Doubts resurfaced Thursday's sell-off and the lingering trade war. However, the euphoria was short-lived. Thursday, April 10th saw a sharp reversal of fortune. The Dow Jones Industrial Average tumbled by 2.5%, while the S&P 500 and Nasdaq Composite Index dropped 3.5% and 4.3%, respectively. This sell-off highlighted the fragility of market sentiment and the ongoing uncertainty surrounding the U.S.-China trade war. Despite the 90-day tariff reprieve, investors remain concerned about the lack of a concrete resolution to the trade dispute. The existing tariffs were still in place, and the possibility of renewed tensions loomed large. Navigating the roller coaster, what's next for the volatile market? Looking ahead, the U.S. stock market is likely to remain volatile in the near term. The U.S.-China trade war continues to be a major source of uncertainty. Investors are also closely watching the Federal Reserve's next move on interest rates. Economic indicators are painting a mixed picture, adding to the confusion. The first quarter earnings season is set to begin soon, with major banks scheduled to report their results. These earnings reports will provide crucial insights into the health of the U.S. economy. Investors will be looking for signs of strength or weakness to gauge the future direction of the market. The market is on edge, and any positive or negative news could trigger significant swings in stock prices. Buckle up, investors. It's going to be a bumpy ride.